For the last few days, there has really been a buying boom in bonds. The government buying billions more in mortgage debt. It's auctioning off new government debt in the form of 3-year notes today. And banks and other buyers have been shifting their balance sheets around. With us now to discuss the big shift in the credit markets and what it means all to you, David Castillo, Senior Managing Director with Further Lane Securities in town from out west. David, good to see you again.
Good to see you, Brian.
We have seen a massive, I know it's hard for people at home to see this, it's all being done on computer screens, massive moves in the bond market the last couple of days.
Yes.
What is going on and why is this happening?
Well, I mean, you've got a couple of things. I think you mentioned earlier that you've got the federal government through the purchases of mortgage-backed securities, through the anointed, 4 or 5 money managers to purchase actual Fannie and Freddie debt in the open market. That is to take pressure off that. So that in one place is driving the mortgage market. Secondarily, with the Treasury market, you've got just, simple demand. People have to put money to work. There are, a variety of places. It's, the Treasuries, if you remember, is the safest place to put your assets. You got to do something with the cash, regardless of what the yield is.
Yeah, but you know what? Money managers are in business to make a return for their investors, and getting 0% basically on a lot of these types of short-term bonds. At some point, don't the money managers have to say, we got to get some yield or we have no reason to exist?
Well, they're actually starting to do that. We are beginning to see people move some of their allocations out of treasuries and out of mortgages and into other asset classes. I would tell you that in places such as the asset-backed securities market, some issues, especially related to home equities, especially wrapped home equity type paper, prices have increased anywhere from 10 to 30% over the last 2 weeks. So we are beginning to see demand in other sectors from people besides just value investors.
Well, let's talk more about the mortgages, okay? Because the one thing I can guarantee you all of our viewers care about is the value of their home, the housing market, or if they don't own a home, what's going to happen to rates. The government is making doggone sure they are trying to keep rates low to incentivize new buyers, correct?
Correct.
But it doesn't seem to be working. If a 5% mortgage isn't going to incentivize somebody to buy a house, what is?
Well, it's not a function of the rate being an incentivification, and actually that rate may drop to as low as 4.5%.
Do you think mortgage rates could go lower from here because of all the buying we just talked about? Well,
all the buying because it's taking pressure on the spreads of the underlying securities, which are a direct impact to what banks are able to finance them at. But remember, the opportunity for the homeowner or for the consumer to qualify for these mortgages is almost impossible at this time. You've got to have north of a 700 FICO, you've got to have a 20% to put down, as well as you have to have a debt-to-income ratio.
So why are they even bothering then? And this has been a theme that you and I have talked about before, right? It's the top-down approach.
Yep.
Why don't they try the other? If this isn't working, note to the government, if it's not working, try something new.
Well,
right?
you and I have discussed, I think, many times that a bottom-up approach, that is putting the power in the hands of the consumer to make decisions on their own. The best way to do that, in my opinion, is via some sort of modified tax strategy. I've always thought that, make the down payment for a period of time for the 20% that someone's going to put down for their home. If that's what's going to be qualified, make that tax deductible. Make that for a period of time until we get through this dislocation. Watch what happens to the housing market.
Yeah, President-elect Obama would like, through his tax cuts, as he calls them, to put $500 or so back in the hands of every taxpayer, so $1,000 a couple. $1,000 is not chump change, but it's not going to resuscitate individual balance sheets, especially at a time when things like property taxes and other forms of things you have to pay for are going up in price. Is that a fair statement?
That's a fair statement. That $500 is going to go to pay the Visa card that month or a shopping trip to Walmart. I mean, it's insignificant on a relative basis to the overall economy. Certainly it's helpful, but it's not the answer. Just giving away cash is not the answer. Incentivize Americans to make smart decisions about their future via some sort of strategy that they're willing to do. And I don't know whether or not Washington's willing to do that.
All right, we have a guest coming up from the Peterson Institute for Economics, deficit hawks. He's coming up a bit later on in the program. One of his contentions is that there are too many banks right now. There's too many banks, even on the regional level, chasing too few people and too few profits, and that we need to consolidate some banks. Do you agree with that?
I think what you've got to do is look at banks not only as just lending institutions. Banks provide a variety of other functions. Really, in the last 5 years, you've actually seen a growth in banks that are specifically tailored towards people that want a relationship. Think about in your community, you've probably got 2 or 3 local community banks where you can still go in and know the teller, the manager knows you, et cetera, as opposed to these big behemoth super banks where you're just a number. I think in that middle market bank sector, yeah, there's probably some crowding. I wouldn't be surprised to see some consolidation, but I think a bank equity analyst probably is a better answer as far as how crowded that market is.
David Castillo, Further Lane Securities, taking some heady topics and putting it in a way we can understand. That's why we like having you on.
Thanks a lot,
David,
Brian.
thank you very much.
Always
See
a
you
pleasure.
soon.
Thanks.
All right, still to come this hour, the Senate says it cannot seat Roland Burris without the signature of the Illinois Secretary of State. But is that